Hey everyone, it's Mark Ferguson with Investor More, and today I'm talking about the new changes to the loan fees that so many people have been hearing about, and how high credit borrowers will now be paying more and low credit borrowers will now be paying less. And I've redone this intro so many times because as I dig through this information and try and do this video, I keep finding crazier and more unbelievable things. So you are looking at the actual table that shows the new fees right now, and I haven't seen this before. And it's not just that high credit, high down payment borrowers are being punished and low credit, low down payment borrowers are being rewarded. Those fees are definitely changing and really close right now in some instances. But across the board, people are now being rewarded for putting as little money down as possible. Even high credit borrowers are now paying less fees if they put less than 5% down than if they put 20% down. It is crazy. So we'll talk about these fees, what's going on, show you these tables, and I'll show you the old table and what the fees were before as well, and a lot of other information. All right, we also have some interesting quotes from government officials about why they did this too. Love the likes, love the comments, love the shares. Most of my videos are my properties, walkthroughs, my investments, businesses, things like that. But I love diving into different news articles and different changes like this as well. So if you haven't subscribed, love to have you as a viewer. All right, let's get into what is going on here. All right, I am at the NewYorkPost.com. I chose this article because it's got some really great quotes and some good information in it. A lot of others have just crazy information, different things going on. It's really hard to figure out what is happening with these news rules when you're listening to social media, articles. It's hard to get the full picture, and that's why I love that I found those tables, which I'll show you here in a second. But here's basically what happened. Fannie Mae and Freddie Mac will enact changes to fees known as loan level price adjustments, or LLPAs, on May 1st that will affect mortgages originated at private banks nationwide. From Wells Fargo to JP Morgan to Chase, effectively tweaking interest rates paid by the vast majority of homebuyers. The result, according to industry pros, pricier monthly mortgage payments for most homebuyers, an ugly surprise for those who worked for years to build their credit, only to face higher costs than they expected as part of a housing affordability push by the U.S. Federal Housing Finance Agency. That's sort of true, but not all the way after all the stuff I found today. We scroll down here. Interest rates are very high. We know that. Well, that's some interesting comments we'll have from FHFA later. Under the new rules, high credit buyers with scores ranging from 680 to above 780 will see a spike in their mortgage costs, with applicants who place 15 to 20% down payment experiencing the biggest increase in fees. That's the important part. The down payment part is more important than credit right now. It's crazy what they're doing. Scroll down some more. LLPAs are upfront fees based on factors such as the borrower's credit score, the size of their down payment, the type of the property, investment property, refinance, all that plays into it. If you ever wonder why your lender takes so long to get you a solid rate, you might feel less or more sympathy for them after seeing all the different crazy fees and different stuff they have in these tables. All right, so this article kind of takes kind of the biggest contrast it can, which is what most are doing right now because that's how the media works and stuff. On a $400,000 loan with a 6% mortgage rate, that borrower could expect their monthly payment to rise by about $40, according to calculations by Stevens, who is someone they quoted here. Sorry, not doing a very good job. Meanwhile, buyers with a credit score of 679 or lower will have their fees slashed, resulting in more favorable mortgage rates. For example, a buyer with a 620 credit score and a down payment of 5% or less gets a 1.75% decrease in fees, a decrease from the old fee rate of 3.5%. So what they're saying is bad credit, low down payment, had a 3.5% fee before. Good credit, big down payment, had a 0.25% fee. And for this particular bracket, the good credit went up to 1%, the bad credit went to 1.75%. So instead of having a huge 3.5% gap, there's now a 0.75% gap. They're paying basically the same. That's a little misleading. We'll show you why in the charts. The charts are still crazy, but this isn't quite, like, that's the worst, basically comparison they could have made to make it sound as dramatic as it is. I don't want to make it sound like it's not crazy, but it's not quite that dramatic. All right. So as far as what that actually means in real life, because that's not your interest rate isn't going up 3%. That's just the fees that can change your interest rate. And basically these fees are charged to banks. So when a bank makes a loan to a borrower, and they sell that loan to Freddie or Fannie, they'll pay, Fannie or Freddie will pay that bank, and the worse the credit, lower the down payment, typically, the less Fannie will pay that lender. So the lender wants to increase the interest rates to still be able to make money. So for bad credit, low down payment loans, the interest rates might decrease 0.4 to 0.5%. Big decrease, $80 to $100 a month on that $400,000 home. For the buyers with good credit, their interest rate could increase 0.2 to 0.3% if they have high down payments. But that's not for everybody. Again, it's very weird. Now, before we get into the tables, I want to quote FHFA. It's crazy. Asked about concerns that the changes will hurt high credit borrowers, an FHFA official told the Post the agency was tasked with ensuring Fannie and Freddie fulfill their role in any market condition. What does that mean? I don't know. Adding that shifts in long-term mortgage rates are a far bigger factor in determining finance conditions in the U.S. housing market. The latest recalibration to the pricing framework that FHFA announced in January 2023 is minimal by comparison and maintains market stability. What they're saying is that, sure, some borrowers have to pay more money now than they did before, but they shouldn't worry about it because interest rates went up so high that these increases are minimal compared to the other giant increases. So I guess if everybody's costs go up and everything becomes more expensive, that's the time to just increase costs on everything because people shouldn't worry about the ones that are smaller. Like, we just ignore those little guys over there. We just focus on the big giant ones. And that was a crazy statement. But again, I was so surprised about what I saw in these tables, which we'll show you here in just a second. Some more quotes. The official said the LLPA changes will result in an average price hike of just 3 to 4 basis points, or 0.3 to 0.4%. 0.03 or 0.04 across the spectrum of mortgage recipients, the equivalent of a few dollars a month. So they're also saying across the board on everybody, it's just increasing a little bit. So you should be okay with it. But some borrowers definitely will pay way more than that and some way less than that. The agency asserts that LLPA changes will help maintain financial health at Fannie and Freddie, a key element of its responsibility as conservator. We will see exactly how healthy you think Fannie and Freddie will be after you see this crazy chart. These changes to upfront fees will strengthen the safety and soundness of the enterprises by enhancing their ability to improve their capital position over time, FHFA Director Sandra Thompson said in a statement earlier this year. Let's see the tables. All right, I am at freeandclear.com /guys /mortgage-topics /loan level price adjustment.html. If you want this link, please comment if I don't provide it and I'll send it to you. Really good information here, but it's updated 2020, which is what I want because it shows kind of the old table of what it was before and how it kind of made sense. So this table shows over here loan to value. So this is, if it's 60% loan to value, you're putting a 40% down payment down. If you have decent credit, you don't have any of these fees. But most people obviously aren't putting 40% down, but that's how you get rid of the fees. And then up here, we can see the credit scores, and this is as the down payment decreases or gets very small. So in the past, if you had bad credit, 620, you'd pay a 0.5% fee with 40% down. But if you put less than 5% down, you had a 3.5% fee. Pretty good size fee. You're paying a much higher interest rate. Now, as your credit score improves, you can see these fees go down, which kind of makes sense, right? The better credit you have, the more likely you are to pay back the loan, make your payments, the fees go down. The higher down payment you have, that's as we go up here, your fees also go down, which also makes sense, right? The more money you put down, the more skin you have in the game, the more equity you have, the less likely you are to default on that loan. Now, there's one crazy thing right here, and that is between 75.01 and 80% loan to value, there's a 0.5% fee that is increased from 30 to 25% down and 20 to 15% down, or 19. So for some reason, 20% down has a higher fee than more or less down below it, which I don't understand that, but the government does weird stuff. So anyway, that little albatross isn't that important. I just thought it was kind of funny. But you can see here, this is basically the worst, right, credit, lowest down payment had 3.5% fee, which is what we saw in that article. And they were kind of comparing it to over here, was it right here? Your 0.25% fee here with 20% down and pretty good credit, right? So how is this changing? Here I am at singlefamily.fanniemae.com, and I just searched for Fannie Mae LLPA pricing tables, and this popped up. I can also link to this. So this is after May. These are the new guidelines that they will have. This is where it gets crazy, and you might think I'm making this up, except it's on Fannie Mae's website. All right, the table is different, so I apologize. They have loan to value on top, and they have credit score on the left. This is why I didn't want to compare them side by side because it gets really confusing because they're different. They're formatted differently. So now they also have 30 to 60% loan to value, which wasn't on the other table. So these two, you kind of ignore those two little things right there. All right, now below 639 credit score, below 5% down is now 1.75. We talked about that. It was 3.5 before, now it's 1.75. Big decrease there, right? And what they're comparing it to was somewhere around here with 20% down, 740 credit score. That went from 0.25 to 1. So that's the big comparisons. We see that big contrast. But you can see there's lots of other stuff going on here. What is the crazy thing I keep talking about? Across the board, no matter what your credit score is, it is now cheaper to put 3% down than 20% down or 25% down. It is the cheapest, unless you're putting 30% down or more, to put as little money into the property as you possibly can. They're rewarding people for the smallest down payments they can. And I guess that's how they're making it more secure somehow. I'm not saying low down payments are bad. I think as many people who can buy houses should, as long as they can repay them, right? The 2008 crash was caused by lots of people buying houses who shouldn't have been buying houses. They had horrible credit. They didn't have the income to pay for them. There were literally stories of waitresses making $20,000 a year buying 3 houses in 1 year. It was crazy what was happening. I saw it. I was in the industry at that time. I saw people getting 120% loan to value ratios on properties. It was the wild, wild west. And they're encouraging. They wanted everybody that could buy to buy, and it did not work out well. I think a lot of lessons were learned there. That's why they implemented these fees. Now, are we going backwards again? I don't know. But you still have to have credit. That's good. You still have to have debt to income ratios that are decent. That's good. But now they're rewarding you for the least amount of money you can put into a property. Now, what's crazy is if we look at, so this is 5% down right here. This is pretty much 10% down right here. It costs you more in fees to put 10% down than 5. Cost you even more in fees to put 15% down for some of these. Not all of them, just some of them. I don't know why. And it costs you even more to put 20% down. And then it starts going down as you have 25% down. So for a borrower with a 620 credit score, their fee will be 1.75% with 3% down. If they put 20% down, their fee is 2.875, over a point higher for putting more money down. Now, if your credit score is 780, best credit score there is, or 800 or 820, whatever it is, if you put 3% down, your fee is 0.125%. If you put 25 to 15% down, your fee is 3 times higher, 0.375%. You are being punished for putting more money down. 3 times the fees, which means a higher interest rate if you're putting more money down. If you put 10% down, or 5 to 10% down, it's only twice as high. It's 5% down. So I know, just a real sidetrack, Dave Ramsey always tells people, get a 15% down mortgage, which has never made sense to me, because you put 20% down, you can normally get rid of private mortgage insurance, which makes your loan way cheaper. If you have 15 versus 20% down, almost always do 20% down to avoid the PMI. But if you have 15% versus 10% down, there usually wasn't that big of a pricing, maybe a tiny bit in your interest rate, or even the difference between 15% and 5% down usually wasn't a huge difference. And we can even see that before if we look at, 15 versus, look at this, 20% down versus 5% down, the same fees across the board. It's basically exactly the same if you get a 5 to a 20% down payment fees wise. Before. Now, Dave Ramsey might have to rethink his recommendations because the 15% down loan is going to have the most expensive fees of any loans. Way more expensive than 3% down, 5% down, and a little bit more expensive than 25% down. So if you're going to get a loan, make sure you don't just say, I want 15% down. Have your lender price out the different down payment options to see what makes sense for you. It might be cheaper to have less money down as far as your payment and interest rate goes. And if you hold the property for a long time, that can add up to a lot of money over time. Now you might have more respect for your lenders after seeing all of these changes and how this works and the craziness that is going on. So yes, high down payment borrowers are being punished more than the credit score, but it's just crazy. So then I want to just real quickly, additional LLPAs by loan attribute application to purchase money loans. So if you have these other factors, this will give you more respect for your lender. Adjustable rate mortgage can add fees onto that. If it's a condo, that can add on more fees. If it's an investment property, look at this, 3.375% added onto it. That's why investment property loans are so much more than owner-occupant loans. Second home is also higher. Manufactured home is higher. 2 to 4 unit property is higher. High balance fixed rate is higher. High balance ARM is higher. DTI ratios make your loan more expensive, and subordinate financing can do it as well. And all of these will kind of add on to your other fees. So what you want, if you want to pay the least amount of fees, is buy a regular house with almost no money down and not have an ARM, although an ARM can still make sense depending on your situation. I love ARMs, but it definitely makes your rate higher. But like I said, talk to your lender about different scenarios. But if you have a manufactured home, condo, bad DTI, that can make your loan much more expensive as well. Now, if you're doing cash out, this does apply to cash out refinances too, limited cash out and regular ones. Those fees are also changing, but they aren't as crazy as the other ones because you can see here, oh no, it's still cheaper across the board to have a less than 5% down payment on a cash out refinance than 20 or even 25. How does that make sense? I don't know, but that's how they figured it out. Again, they have additions, more cash out information here. So all kinds of information here if you want me to link to this. But basically, what we've come away with, it is now way more expensive to put 10 to 25% down on a house than 5 or less. And if you want to pay the most expensive interest rate you can, put 15% down, 15 to 20 in that range, and you'll pay the most money. And this, according to FHFA, is how we make Fannie Mae and Freddie Mac more secure, is to encourage people to put as little money down as they possibly can. All right, so going back to that quote, just in case you forgot about it, these changes to upfront fees will strengthen the safety and soundness of the enterprises by enhancing their ability to improve their capital position over time. There you go. All right, let me know what you think. If I missed anything, if I got anything wrong, please comment below. I see everybody's comments. I can't always respond to everyone, but thank you so much for those who do take the time out to comment. Love the likes, love the shares, and I also love seeing new subscribers too. Like I said, I'll have a lot more videos of my properties and progress and remodels and different stuff going on here coming up very soon as well. Thank you so much. Be back soon.